Now, the second chapter of our Investing 101 series is on the different asset classes in the market. Now, by understanding these different asset classes and their relative risk, this will help you to decide which asset classes will fit into your investment profile. Now, first, cash. You are likely to be most familiar with cash. Now, cash and cash equivalents are basically short-term, easily accessible, and those that are maturing within 1 year low-risk asset. Now, among some of the examples are your physical cash, your e-wallets, or the bank deposits. Now, for example, with bank accounts, you earn interest from your bank. You are guaranteed of the capital. However, the downside risk to this is that the interest earned from saving account are usually eaten up by inflation. Second, bonds. Now, a bond is a debt instrument which represents a loan made by an investor to a borrower. Now, a typical bond usually involves a corporation or government agency where the borrower will issue a fixed interest rate to the lender in exchange for the usage of capital. Now, government bonds are usually seen as lower risk as compared to corporate bonds, and corporate bonds are dependent on the ratings provided by the credit rating agencies. Third, mutual funds. Mutual funds are investment where a group of investors pool together their money to invest in different types of securities such as the stock market, bond, or any other asset classes. Now, mutual funds are managed by portfolio managers which allocate this capital market based on the fund's objective and mandate. Now, it gives small investors the access to a diversified portfolio that is managed by professionals. Now, there are different types of mutual funds depending on the asset classes that they're invested into. Now, the risk of these funds vary depending on the asset classes that they invest in, but it is generally lower due to the diversified nature of mutual funds. Mutual funds are valued at the end of a trading day, and the buy and sell activities are also done after the market are closed. 4. Exchange traded funds, or more commonly known as ETFs. It is very similar to mutual funds, but they are tradable throughout the day just like stock market. This leads to a higher volatility for ETFs. Now, ETFs tend to track an underlying index such as the S&P 500, for example. It can also track other baskets of stocks depending on the issue of the ETFs. 5. Stocks or shares. Now, investing in the stock market allows investors to participate in the invested company's success based on the share price movement and the dividend received. Holders of common stocks enjoy voting rights during the shareholders meeting, while holders of preferred stocks do not have voting rights. However, they do receive preference over common shareholders in terms of dividend payments. 6. Alternative investment. The alternative investment universe is huge and includes everything that does not fall under the conventional investment, such as cash, bonds, or stocks. Now, among some of those are hedge funds, private equities, venture capital, managed funds, art, wine, antiques, commodities. Now, real estate is also often classified under alternative investment in recent years. Now, we also saw some decentralized finance alternative investment recently, such as blockchains or cryptocurrencies. Now, the risks tied to alternative investment are difficult to measure, and sometimes those are also not regulated by financial statutory bodies. This is why when you invest in alternative investment, you need to understand the type of investment that you are putting into.